Can you hear me now? All right. I apologize. I I have I have a little clip-on mic that I usually use, and it's attached to this little battery pack, and usually um, lasts forever. But I guess I hadn't checked the battery indicators in a little while, and the battery on my microphone was dead. So thank you for giving me the feedback and for being patient with me as I tried to get that fixed. Okay, well, let's go ahead and dive right in. With that, no more delays in mind. It is the third December, or excuse me, the third Friday of December, and that means that, of course, there are always things going on in the market. There is a question that I have before we do anything else, and this is something that we did around Thanksgiving too. Um, this is about next Friday. December 26th is obviously the day after Christmas. And I am going to open this question up to everybody. We can have this session or not, but I'm posting a poll right now in the chat area, and if you can go ahead and give me a response to that as to whether or not you think we should. I'm open either way. I love to have this session, and so if we decide that's what we want to do, that's awesome. If you'd prefer to take the day off and enjoy, the Christmas weekend, the holiday weekend, then that's totally fine too. So majority rules. This is something I'm going to leave up to the group. If it's a tie, then we'll see what happens. Maybe I'll take the tiebreaker. Okay. Let's go ahead and dive in. As I mentioned, it is the third Friday of December, so that means that not only are regular options, not only do we have weekly options that are expiring, but we also this is also the regular third Friday of the month, so normal options are also expiring today. So it's kind of a double, kind of a double dose of expiration today. And there are a number of positions that we have on deck that we've been following that are set for expiry. A couple of others that we'll be able to pay attention to for the weeks ahead. But let's go ahead and get straight into it. I'm going to focus on the put selling trades first, and then we'll move into the covered calls. So the first one is on Target, and this is a trade that I placed at the beginning of December. I sold the $89 strike price, brought in about 1.7% for that trade. This is a 2-week trade, 1.71% over that 2-week period. That's a nice trade. I like that. So let's see how this goes. Thanksgiving Barry says, I tend to stay up late and sleep late. Black Friday, I slept until about 10 Eastern time, which has been halfway through the session. That's totally fair. I am not much of a night owl, but I also have mornings take me some time to get things rolling and get my mind going. So I usually have to get up well in advance of this session in order to be halfway coherent. Obviously, that didn't exactly work out as planned this morning. Okay, so let's start out with Target. And we see the stock has really been, it's interesting for me to say, it's been picking up a lot of momentum. The chart really doesn't look all that impressive considering the strength of the stock's downward trend. But if we go back here to the latter part of November, we see that the stock has risen from what's this? Probably a low at around 83 to its current price, now pushing close to 98. It was a little bit above 99 at the start of the session. Barry, I totally understand that. Yeah, 5 a.m. your normal wake up time. Take advantage whenever you can. I love my extra opportunities to sleep in as well. All right. Even when I do wake up early, it doesn't mean I'm actually up early, right? So the stock has been showing a lot of upward momentum. My $89 strike price is right about here. And so this is where the stock was at when I placed the trade at the beginning of December. So we're obviously in a really, really good position unless we see a serious sell-off, even sharper than the 1% we've had so far today. It looks like this stock is going to expire worthless, this trade, excuse me. And that's an okay result. It's a result, not necessarily the desired or not desired result. It's just the result. But that does beg a question with the $89 strike set to expire, having brought in $1.52 per share. All right, Barry is in at $90. So a little bit higher, but a little bit longer term. Okay. So I need to expand the list a little bit. There we go. And here's mine. Here's the $89 strike. And you can see here 51 cents on the listed ask. That's obviously just because of the fact that it is so out of the money that there's been no activity, and which is what we can see here. Barry brought in $1.67, which is awesome. That's a great result. You got it a little bit more in premium than I am. Let me know when your expiration is. Let's just for comparison. There's lots of open interest here. The reason this is useful is that since the option expires today, this asking price is going to change. That's because every hour that we get, okay, excuse me. So I misunderstood. $1.67 at 90. So you went a little bit higher, brought in more. Same expiration. There you go. Barry beat me. That's nice. Time decay has now become a not just a daily thing for this trade, but it's now literally an hour by hour. And as we get closer to the close of the market today, it's become a minute by minute thing. So if I wanted to do different than my normal wait for the expiration to happen and accept the result, if I get assigned, I get assigned. If I don't, I don't, and deal with normal trade settlement, I could put in a buy to close order on this stock. And instead of just taking the 51 cent ask right now, I put in 10 cents, maybe 5 cents, something like that. If I'm willing to, excuse me, if I'm willing, wow. If I'm willing to wait for the market to come to me, then there's a good chance that that I'll be able to get that trade. It's probably not going to happen immediately. I'll probably have to wait a little bit. But this 1,224 contracts in open interest does imply that there's I would probably be able to close this position before the market closes. Why would I want to do that? If the stock is so clearly going to expire worthless, this really becomes all about dealing with trade settlement. If I do what my normal thing is, of course, I have to deal with normal trade settlement, which means that the $8,900 I put on reserve, I sold one contract, so that's only on 100 shares. So that $8,900 doesn't become available for me to place another trade with until probably Tuesday at the earliest. Trade settlement for most brokerages now is normally 1 to 2 business days after expiration. So that's when you let normal expirations happen. You can shorten that process by trading, being a little bit more active in your trade management, of course, which means placing a buy to close order earlier. If we had done this, say, a couple of days ago, perhaps, then it would the mechanics would be the same. The logistics might be a little bit different, though. But considering the momentum here that we've seen in the stock, certainly there have been opportunities to buy this back really for the past week. We talked last time about some of those opportunities and how you can when you buy it back, you can increase the trading frequency that you're working with the stock. That also allows you to increase the compounding effect that you get from these income generating trades. So here's my question. Barry's in at 90. I'm in at 89. And the stock has clearly lifted quite a bit away from either of those two contracts. So for the rest of you, what do you think? Is this something that you would want to consider rolling ahead, not only in time, but maybe to a higher strike price with the stock up here just a little bit below 98? That means the $97 strike price is the first out of the money strike. It's a little under 1% for next week at 97. $1.24 here for 2 weeks. Take a look at 3. Here's $1.71. Now we're getting a little bit more interesting. This is a little over 1.5%. Or possibly for a month. If we go to a month, now we lose the $1 increments. Now we're looking at the first out of the money is the $95 strike price. This is interesting just by comparison. Here's 95 with $1.77 on the bid for an extra week. This becomes quite a bit more conservative versus the January week 2, which is 97. So it's $2 higher, and not just a little bit under the amount of premium that you get for the 4-week at 95. So that's possibly interesting. Give me your thoughts. I mean, is this something that would be worthwhile? Would you prefer to move on to something else, given the way that Target's momentum has lifted the stock so far? Do you think maybe it's better to wait and see if it pulls back? What are your thoughts? Barry says, much of the time I can get into the midpoint if there's a lot of interest. Yeah, that's absolutely right. And that's why, even though there's no volume on the current contract, my current contract, I should say, I'm really not too worried about this current asking price. There's plenty of open interest. So even if I were in a hurry, I could cut this number in half, go in at, say, 26, 25, maybe even 20, and would probably get that trade taken pretty quickly. If I were willing to be more patient, then I can go down lower, 10 cents, 5 cents, whatever. So what do you think? Is this something, is Target going to be a stock that you would think would be worth rolling out in time and up in price right now, or has this already moved far enough that it would be better to go find a different trade? Tell me what you think. Yeah, Barry, possibly still a bargain at 97. The value price that I've got for Target is much above is far above 100. So actually, I still think it's still a pretty good bargain at 97. So and for those of you who are interested in, a little bit of kind of momentum based trading with these, maybe you're a little bit more active about the way that you manage the trades than I am. These little cycles in between highs and lows become a little bit more interesting. And considering the way that this has rallied, it's certainly correct to assume, well, not guaranteed, but reasonable. Gibb says I wouldn't roll up, and that's fine, totally fine, Gibb. It is very reasonable to assume that the stock is due for a pullback. To my mind, there's a couple of things to keep in mind that suggest that even if it does pull back, it may not pull back very much. The first is the 200-day moving average. The stock has it started pushing above the 200-day moving average as of the end of last week, and this is starting to flatten out. So this should start to become really strong support as the stock is held above it. In fact, here's if you look at it on a day-by-day basis, 1, 2, 3 bounces and holds at around the level of the 200-day moving average, which is around 96.50. So even though it's pulling back now, it is looking like it's got pretty strong support at 96.50. Also, the 20-day moving average is clearly moving up. Now, again, we've seen the variability of the 20-day moving average, right, as a shorter term moving average. But the thing that is really interesting about these, besides the fact that the stock is above both of them, is the way that they're starting to form this classic wedge pattern. What that implies is that support for the stock is strengthening. And with the stock above, I don't have a black one, so I'm just going to use this. With the stock sitting above the 200-day moving average, that strengthens the idea that this 200-day moving average is going to act as support. And even if it does, again, there's very limited downside with the 20-day moving average coming up as well. So could it pull back? Yes. What is the likelihood, however, is that even if it does, it's probably not going to drop much below where the current 20-day moving average is at, which is at about 93. So that could make this kind of interesting. We'll see, obviously, what happens and where this goes, but this is looking very, very interesting. If it's still in the same general price area next week, I'm going to, of course, let my option expire because I'm okay with dealing with normal settlement, and it's just easier for me that way. When Tuesday's trade is coming up, I'm going to be very interested to look and see what the stock is doing, and if it's continuing to build some momentum here, this very well could be the very early stages of a long-term trend reversal. Not guaranteed. Certainly, we're still very early in that process, but it's looking very encouraging. Gibb, how do you pick your start points on a wedge? It's really up to you. For me, since I'm really a value-driven investor, and my signals are usually based more on value proposition and fundamentals than on timing. If I'm seeing that the stock should have pretty solid support here, I don't really worry too much about my starting point. I just put in my order. If you want to get a little bit more technical, about it. You could pay attention to, obviously, to what the stock's momentum is doing right now, and wait to see some additional stabilization around the 200-day moving average. For example, let's say that Monday the stock formed something like this, an open candle, and it may or may not be a doji. This is just my bad drawing, right? But what you see, if you see an open doji, maybe like this one or any of these, above the 200-day moving average on Monday, for example, could be a really good sign that support here at this level is strengthening, and that could provide a good technical starting signal if you like. So it really just depends on your preference. For me, it's really about whether or not the overall technical pattern looks favorable enough, which this does to me. More importantly, is the value proposition is still there, the fundamentals are solid. So that's really about all. That's really about all I need. Beyond that, I just go and I place my order. I don't always place a market order, so I'm not that indifferent to price. But beyond that, seeing the stock coming down here now about 97. If I were to put in an order again, this is not a recommendation to buy or sell, but I would probably go for some variation of this on the current bid and ask, which is, let's take a look. Bid 96.88, ask 96.93. I might look for an entry somewhere around 96.90. Yeah, something like that. So I hope that helps, kid. Okay. So that's Target. There's also a couple of covered calls that I have that are set for expiry today. First one is on Halliburton. This is a stock that I've held for a little bit. We go back here on my trading log. I was assigned this stock in March of this year, so I've held this for about 9 months, and that's been productive. Even though the stock dropped well below 26 after the put sale, which is why I was assigned, and I've watched it stay below that. I've had a few opportunities to be pretty productive with it. This is a good dividend-paying stock, and so that covered call offered me an opportunity. As always, I put in the wrong company. There we go. Could see here it dropped all the way down and actually below 20 in the spring, and it took quite a bit of time to recover here. Lately, it's come off of a peak at around 29.50, but is now around 27.79. So this is in a very good position for me to go ahead and call me out of the trade at 26.50. So I've obviously given up some capital gains on this. I'm okay with that. This has been productive as a position on its own. And even though I'm giving up about $1 in a total capital gain, and arguably more than that because I didn't close the trade at the top of the move here around 29, the covered call gave me an immediate dividend on the stock on top of the dividends the stock just pays by itself, and I'm giving myself about a 50-cent capital gain on top of it. That's good enough. And really, that's the main criteria that I think that the traders tend to forget about when they're thinking about covered calls. A lot of people avoid covered calls for the wrong reason. They read broker disclosures and educational materials, of course, and they see the part where they say that the covered call puts a cap on what your maximum gain is going to be. And yes, that is totally correct and accurate, but that's where they stop. They don't think about the trade anymore beyond that. What they are ignoring, or what they're making the assumption is that the stock is going to move above the strike price that you sold on the covered call. Well, that did happen in this case, right? But it's not a given that it's going to. I have a lot of positions where I'm frequently able to sell multiple covered calls over time. And each of those covered calls become a dividend on their own. I mentioned, as you know, I focus on dividend paying stocks. So I'm bringing in these quarterly dividends on these stocks that I take assignment on, and that's great. I love these dividends. That's part of the reason that I work with these stocks. But if a stock doesn't move above the strike price that I sold, it expires. I just get an opportunity to sell another covered call, pay myself another dividend. And even if I do get called out and the stock is well above the price that I sold, what I have to think about is the capital gain that hopefully I was able to bake in with the trade, but also the dividend that I paid myself. And so this was the overall, this 2.12% was the number that I focused on when I decided that I was going to place this covered call trade. This is the return on the covered call itself. It does not factor in the 50 cents of capital gain here. This was just, is this income sufficient for this 3-week period of time? And by the way, if you don't like the idea of 2% in 3 weeks, then, this is definitely the wrong kind of trade for you. But this is a really, really good result out of this stock. And this is something that I was more than happy with. When you bake in the fact, when you add in the fact that I had an extra 50 cents to increase the premium increase the total net return if I'm called out to $1.05, then it looks even better. $1.05 divide by my $26 assignment price. Now that's 4.03% just on this one trade. That's not talking about the return of everything that's happened in Halliburton since I was assigned, because I've had other covered call trades like this one. And I've had the dividends as well. So my overall result is definitely not just this 2.12%, but I do have to consider each covered call on its own merits and decide if that result is acceptable for the time period involved. And in this case, it was certainly more than that. So this is overall a good result. I like it, and I'm happy to be called out, even though I'm giving up some of this capital gain. Capital is being released, and so I sold 2 contracts on this. That's a $5,200 total reserve requirement. That's how much money has been tied up in those shares for the duration of the position since I was assigned in March. So it'll be nice to have that come back and become available as cash, increase my financial flexibility a little bit. I like that. That's a good result. And that's really all that I need to know. That's kind of the end of the evaluation for me. And that's why I like to use these covered calls. This becomes the known quantity. This is the low-hanging fruit of the market. This is what I know I can get from the market right now. We'll see the same thing when we look at Schlumberger, which is coming up next. So, any other thoughts, any comments on Halliburton at all? Okay, let's go ahead and move on. The next one is another stock. Talked about this one several times in the past few sessions, and that is SLB Limited, formerly Schlumberger. I guess they renamed themselves for simplicity, but I also kind of liked saying Schlumberger. Sounded interesting. Anyway, this is a stock that I've not held for as long as Halliburton, but in this case, I was assigned in August at 35. And so this covered call, I've had multiple of these covered call trades in Schlumberger since then, because of the way that the stock has been moving. But in this case, my covered call is at 37. So I have a $2 potential capital gain baked into this, a little bit more, obviously, than on Halliburton. Was also able to bring in 90 cents for a 9-day trade. Oops, sorry, wrong one. That was an expired trade. So here is this one. I only have a $1 capital gain built into this one, and brought in 91 cents. Again, this is a 3-week trade, bringing in about 2.6%. This is also still a good result. I have 100 shares in this stock, so a little bit more conservative position. At $3,600, $3,500 is my total cash in this one. So it's not as big as with Halliburton. That's okay. I like working with conservative position sizes, especially, with the market being the way that it is right now. I think being conservative about your position sizes is more important. So we can see that the stock it's been following basically the same pattern as Halliburton. The nice rally here since October. Also peaked at about 40.50 and has dropped down off of that level. And my covered call is all the way down here at 36. So when I placed the trade, it was all the way down here. Saw a lot of momentum to the upside before it dropped back. So I am giving up a larger potential capital gain on this one. But again, the mindset for me is the same. The known quantity, what I knew was available, on this trade was 91 cents on the covered call at the $36 strike price. That was 2.6% on the money that I had in the position, and that was more than enough for a 3-week period of time. And so this was more than acceptable. If I add in the $1 on top of the 91 cents, and then I divide that by my $35 assignment price, 5.45% is the total return for this particular trade. When I add in the other covered call trades that I've had on that, I'm not going to do the math, but I've done that in other sessions. And I know that most of you in this group have seen that. This has been a very, very productive position. And Schlumberger is a really, really good example of I'm not going to say that I get this kind of result out of the stocks that I take assignment on frequently, but I usually do get a handful of them every year, where they stay close enough to the strike price that I was assigned at, that I'm able to use multiple covered call trades. So here I was assigned back here, and can see that there's been, enough activity near all the way through this period around the $35 price range to make this a really productive stock for covered call trades. That's really all I need. If I can get a handful of these every year, along with the regular number of put sales that expire worthless, and even the stocks that I do take assignment on that are maybe a little bit less productive and I have to be a little bit more patient with, the overall net result tends to work out really, really nicely. So, okay. Any thoughts, comments on Schlumberger SLB Limited? Excuse me, Schlumberger. Those are the trades that are set for this week. Next week, I have a put sale on FCX where I sold the $44 strike price. This is a 2-week trade, bringing in 1.8%. And again, if 1.8% for a 2-week period of time doesn't thrill you, okay, I get it. I like it. I'll take 1.8% every 2 weeks. Every 2 weeks. So, all right. Stock, again, following the same kind of pattern as what we saw with SLB and Halliburton, showing some really, really nice momentum here. And I sold the $44 strike. So it looks like this is in a very, very good position to expire worthless. The fact that we are a week away from expiration on this does mean there's a good opportunity to evaluate the potential for a rolling trade. So let's collapse this week's expirations, and I'm going to need to expand it. Let's go to 16. Even then, that wasn't enough. Wow. Okay, there we go. So again, for reference, brought in 79 cents on my put sale. And at the $44 strike, you can see there's no activity going on in this, and about 19 cents on the ask right now. Now, if I wanted to close this out, take advantage of the positive price momentum that we've gotten from the stock, if I don't monkey around at all with the difference between bid and ask, then I would hang on to about 60 cents of the premium that I put into this trade. I would also shorten the trade by a week. So instead of a 2-week trade, this becomes a 1-week trade. Barry got a penny more on the same trade. You beat me, you get a mark. That's the rule, right? So good job. So 60 cents may not sound like a ton, and it's a little under 1.5%. Well, let's remember this this would turn my 2-week trade into a 1-week trade. This is why I like talking about the advantage that a lot of our more active traders give themselves. By increasing your trading frequency, this is the net effect on compounding. When you take this and you turn a 2-week trade into a 1-week trade, if you can do that consistently over the course of a year, obviously you're going to place more trades, 52 trades as opposed to 26. On the same money, same kind of conditions, etc. There's some broad assumptions that are being made here for me to run the number the way that I did, but you're talking about potential of leveraging the same capital to the effect of almost 71% total growth of that capital. That's really, really useful. Now, by comparison, for the same trade, and if some of our friends were on this session, I know they'd be screaming at me saying, "Why aren't you placing that trade? Why aren't I watching you do it in real time?" But if I just let this expire, if I let this go all the way through expiration, go through my 2 weeks, right, I'm only able to place half as many trades. So here's my 0.79 divided by 44. Here's my 1.79 result. Again, this is a good result. This is something I'm happy with. When I multiply this by 26 trades, now I'm looking at 46.6% per year. This is also a really nice result, but it's not. But you see the difference between my result my potential result, I guess I should say, versus the kind of result that you can leverage by trading a little bit more actively, even giving back, the 19 cents that you'd have to pay, or you'd have to give back to the market from the premium that you brought in here. You still get a much bigger net overall result. Now, the truth is, considering that the trade for the day was at 6 cents, you probably could put in a buy to close at 6 cents and it would probably get taken. 10 cents almost certainly would. So you would certainly not have to take the asking price. I'm just saying, if you decide you didn't want to monkey with it, there's still a really, really good result. This is why a lot of the people who do use put selling more actively, when I talk to them about the real details, they'll say that if they're looking at a trade that is 1 to 2 weeks away from expiration, and the stock has moved enough that they could close out the trade and still keep at least 50% of their premium, then they'll usually do it, because of the way that this compounding effect increases the overall net result. So that's a pretty good benchmark. If you're thinking about trading more actively and you want to kind of establish a baseline expectation for when you're going to do it, use that 50% mark. If I brought in 79 cents on my premium, and I divide that by 0.5, then I'm getting, what is that, 39.50.395. So anywhere between 39.40, 39 cents, 40 cents, then it becomes a time to think practically about whether or not making a more active trade would be reasonable. Okay. All right, we've got some time left, and we've pretty much talked about everything that I wanted to talk about. Of course, there is the put sale that I placed this week on CTRA, selling the $25 strike price, brought in a little under 1.5%. This is a 30-day trade, so we're just getting into this one. But the stock is holding nicely above that $25 mark, and we've got really good support here from the 200-day moving average, a little bit above 25. I'm just going to call it 25 for simplicity. But a little ways to go on this one, so we'll see how this one works out. But with that in mind, we've got some time left, and I'm going to try to give some time back because of the technical difficulties at the beginning of the session. By the way, if you haven't already, please do respond to the poll. Looks like all we've gotten so far are yeses. If you haven't responded, please do, so we can decide what we're going to do next week. All right. Do have some time to look over some of the other stocks that maybe you're following. So, Barry, thank you. PZZA. Papa John's. Very interesting. When he was in college, my son worked for these guys. Every time I buy Domino's, he gets angry with me. Okay. Papa John's. Looks like the stock is showing some support here in the $40 area. And Jay will definitely take a look at Nike, too. So, Barry, you placed You placed a put sell here at 40 for January week 3 and brought in $1.80. Okay. Well, that's actually pretty that's actually pretty impressive if you think about it. $1.80 divided by 40, 4.5%. Hoping after all the holiday food, folks will crave pizza. Even during the holidays, let's face it, I'll take pizza sometimes just as a change of pace. Seeing a nice consolidation pattern. So, Barry, this is a very interesting trade because you've got what looks like looks to be developing here is a nice little stabilization pattern, consolidation pattern after the stock retraced quite a bit, all the way down from 54. Now, just for the full, interest of transparency, I haven't gone into the details for Papa John's aside from eating their pizza. I can't speak to their fundamental strength, their overall value proposition. So, Barry, being diabetic, have to watch the carbs. Sure, makes sense. But there is a nice stabilization pattern here, and that means that if this support does hold, as it looks like it is, then not only is that going to be useful for your trade, but that could also mean that there's going to be several opportunities here to work with work with that pattern, possibly with multiple income generating trades. Let's see, the dividend, he says, is not great. Well, you got 4.5% on the dividend yield, which is higher than average. I guess the question here is you say the ratio looks like it's pretty high. That's not always a sign of trouble, but it does beg a number of questions. It'd be interesting to dive into the balance sheet and see if some of the other things imply it, whether or not that payout is in any kind of danger. But they've also been maintaining it for a little over a year. Two years. Let's try a little bit further. 42, 42. Okay, so they raised it to the current level in August of 23. They've been maintaining it at that level ever since. That's not nothing. Gibb says the bid ask is too wide for your blood, and that's fine. Let's take a look. So this doesn't have weekly options. So stock is around 40. That means this is the in the money, or excuse me, the first out of the money contract. And yeah, so this is a little bit high, a little bit of a wide difference. But let's look at the details. This is really the main reason. That doesn't mean that there's not liquidity in these contracts, to be clear. This is the better indicator of liquidity. The volume number is going to be something that is going to tell you whether or not your trade is likely to be taken quickly. If you're going to wait for the market to come to you, then usually you want to be a little bit less specific about the trade, that about trying to get the bid price you want. If you're comfortable with this number, if that's good enough, then that's fine. If I were to put in a sell to open on this at $1.80, it would probably get taken pretty quickly. This would be harder to roll simply because of the fact that you don't have weekly options, so there's not going to be as much implied volatility to deal with. That is certainly true. You also have $2.50 increments between strike prices. Open interest is actually I consider open interest to be more than adequate. I'm going to disagree with you on that one, Gib. In my experience, open interest, open interest, if you're anywhere above 100 to 150 contracts in open interest, there's usually more than enough liquidity. This has 1,000. That's the $40 strike price. If you go down here, 2,000, if I go up to 42.50, even this is not as high, but 702, more than enough. So, yeah, and if you're not much of a roller, then maybe that's okay. Again, this really boils down to a couple of primary things. What is your overall evaluation of the stock, of the company, and is that going to be something that is going to make you willing to take on the stock as a part of your portfolio? Other people in our group have called these legacy positions, right? Or is this going to be something that you are willing to consider as an active part of the portfolio that you're going to manage? If it is, no sweat. Then do it. They do make good pizza. Okay. Gib wanted to take a look at Nike, so let's do that one. Wow. Right after the earnings report, which came out yesterday, big gap down all the way from 66. Opened the day at, it looks like, around 59, and now we're up at 60. So overnight gap. And this is a really good example of the kind of volatility that can happen around earnings. Looking at the wrong column. Okay, no sweat. Here we had it in July. Here was a big gap up after earnings. So that was a nice positive one. Here's a gap down. Here's a gap down. They're not exactly unusual. Here's a major gap down, 2024. Market does this to Nike sometimes. I can't speak to what that means for the value proposition, overall fundamental strength. I have not gone through the numbers from this report yet. Still waiting for those to come through to my normal data sources. So, market tends to try to fill gaps. So, perhaps it might be a good trade for the near future. It is going to be really interesting to pay attention to. And to your point, Barry, there is a technical concept that I do agree with, which is that stocks tend to fill their gaps by about half in the very near term. So that usually suggests, is not always true, but that usually suggests that if you're looking for near-term trades, if you take the halfway difference from 66 to 59 roughly, gives you around 62 and a little bit. So the midpoint is somewhere around here. That suggests that the upside in the stock is probably in that range roughly. And that's not bad. It is going to be interesting to see how the market treats it in the next few days. I'm certainly going to be paying attention to see how the numbers look when they filter through to the rest of my data sources, my data feeds, so that I can redo my analysis on it. This kind of drop, I'll be honest, it does pique my interest, and it may increase the chances of a new trade in Nike in the weeks ahead. Not guaranteeing anything yet, but that's certainly a possibility. So, thank you, appreciate that, Gib. All right, we've gone a little bit over time, so I do need to call. Yeah, that's exactly right, Barry. For those who make their living on buying options, it might be a good one to evaluate. Possibly that short-term distance here, very near-term positive momentum. Again, I'm going to want to see if this continues through the day, and possibly what happens, on Monday before I would make any real clear decision. But that's me. Okay. Thank you, everybody. Really appreciate your time as always. If there are any questions between now and next week, looks like the poll finished just at 50%, so I'm going to call it. And we're going to since there were only 2 votes, one for yes, one for no. I'm going to go ahead and say yes. So we will have the session next week. If you're able to join, wonderful. As always, please do share this with your friends so that we can try to grow the Rebel Income community. Really appreciate your time. Hope you have a wonderful holiday. Spend time with your loved ones. If you have any questions between now and next week, don't email me on Christmas Day. I won't answer then, but I will be here the rest of the time. Awesome. Looking forward to seeing you, Barry and Gib, and anybody else that tunes in. So have a wonderful holiday. We'll talk next Friday. Thanks again. See ya. Barry, roll tide. There you go. BYU on the 27th. So got to beat Georgia Tech. Thanks, everybody.